Welcome to the Two Wealth Show, a show that shares how you can create real wealth for you and your family. I'm one of your hosts, Justin Bogard, and my co-host is Elizabeth Sickles, aka Super E. I am a real estate note investor, specializing in performing residential real estate debt. I find the deals, acquire them for my own portfolio, as well as educate investors while walking them through the process of owning a real estate note. My co-host Super E, a real estate investor, specializing in short-term rentals and the management of them. She connects investors with short-term tenants and manages everything in between. Our show is sponsored by BrightPath Notes and Elizabeth Mayora. You can find out more information by visiting our websites at brightpathnotes.com and elizabethmayora.com. Hello, everybody, and welcome back to the Two Wealth Show. This is episode number 7. I'm Justin Bogard with BrightPath Notes, and my co-host is
Super E, Elizabeth Mayora with Elizabeth Mayora. Welcome.
Elizabeth, it is so great to see you again. I love how we can do this stuff online. I know I was thinking earlier today, Elizabeth, we used to actually record this kind of like a newsreel, and we were in this really nice setting. We had these beautiful light set up with these high definition cameras, and we looked so cool. And then COVID happened, and we're just like, Justin, what are we going to do now? I'm just like, I think we're just going to have to do Zoom or something like that, right? And so we've been doing that pretty much for the entire second season. I would say I think we got about 5, maybe 6 episodes in of we'll call regular podcasting. And then we had to do this online thing. So I don't know. I think it's worked out pretty good, Elizabeth. What about you?
I do. I need a little bit different lighting to make it more professional, but other than that, it works.
Yeah, it's. I think it makes travel easier, right? Because we don't have to go anywhere. We don't have to, have time to and from, and then setting up and breaking down all that equipment. It was a lot to do. So this turns out to be a lot more efficient for us, right? So,
that's true. It does. Or it is, I should say.
Yeah, Elizabeth, as you probably realize, we've got a credit crunch going on that's continuing to crunch even more. All right. This is known even more prevalent, if you will, because Fannie Mae just came out with some information that says they're cutting back on buying some of these loans. Okay. So what does this mean? A GSE is a government-sponsored enterprise. Fannie Mae is one of them. Freddie Mac is another. Ginnie Mae, is another. And so their job, for those of you that are listening and watching, and Elizabeth knows this, is to buy these loans that the banks create. Okay. And why would a bank sell a loan? Well, they want to get liquidity, right, Elizabeth? Mm-hmm. So they create a loan, they charge fees for it. They charge, for appraisals and loan origination fees and all that things like that. They may hold the paper and they may hold the loan on that at their bank and service it for a few months and then sell it. But traditionally, they're probably going to sell it pretty quickly to Fannie or Freddie because their job is to buy these loans from the banks so that the banks can have liquidity and they can go originate more loans because they do it in volume. Guess what? They end up having the biggest buildings downtown. They're on every street corner, and the banks somehow make money through any economic time. So that's the secret sauce right there is one of them. So Fannie Mae, like I said before, has decided to cut back on buying some of this paper from banks. Now, not all paper, Elizabeth, but specifically the investment type property paper and the second home type paper. So this is like non-primary residence type of mortgage notes that are created. Mm-hmm. So they're doing this because of a credit crunch. They're starting to see that they need to have tighter restrictions on people because they're probably seeing the writing on the wall with inflation and people borrowing more money than they can afford to pay back. And so this is what happened in the 2008 2005, 2007 timeframe, where people were just handing out money left and right. You can get a $500,000 house and make $50,000 a year. I know that's probably an extreme example, but you get the idea, right, Elizabeth?
That's right.
So that's a problem, right? They probably can't afford it. And then we had foreclosures, and then there was this after effect. And you all remember more than likely what happened then and what was the aftermath of that. So the banks, when they sniff or they feel like there's some sort of problem like that, they start tightening their restrictions because they want to make sure the borrowers, somebody like me or Elizabeth or whoever, is going to be able to pay back that debt and be consistent about it, right? They don't want any problems. They don't want to deal with anybody missing their payment and being too high to debt to income ratio. So that is the story that came out, and that's kind of what's happening. So Fannie Mae is one of the biggest ones, right? So you would imagine that the others are going to follow suit to some extent. So what I'm saying is, when I'm reading this information, I see an opportunity and I see a little bit of a problem, right? The banks, if they continue to create these loans, they are going to have no one to buy them. Well, someone's probably going to buy them. It's just at what price, right? The banks will start writing them off on their books, and they'll figure out at what price point do they want to get rid of it, or do they want to keep it long-term and trying to work it out. More than likely, they'll probably sell it off. But Fannie and Freddie and those other GSEs, they really dictate exactly what the banks are going to do, because the banks know, like, this is my end client that I'm going to sell this to. What is it that they want? And I'm going to model exactly what they want. So I'm creating a product that I can deliver to them. And so that's what I see happening with that article.
So you mentioned Franny and Freddie, and then Freddie and Fannie.
It's confusing, yeah.
And did you say GSE?
GSEs, government-sponsored enterprises.
Okay. And when that happens, so when they start selling those off, Justin, do you buy those as a note investor, or who do they sell those to?
So they would be selling them to probably very large hedge funds, like, let's just say Goldman Sachs, or, big Wall Street firms will probably start buying those. And we're talking about the big banks, like the big five, if you will, the Bank of America, the Chase, who are the Wells Fargo, all the big ones. Those aren't loans that we as small-time note investors can buy from, because quite frankly, we're peanuts to them, right? We don't have billions of dollars backing us to buy their inventory. Now, when you get to the smaller branches or the regional banks or the small, 1, 2 to 5 branch, type of banks, then they'll have a conversation with us, and we might be able to get in there and buy some loans from them. But traditionally, no, it's not going after the big banks. It's going after the smaller banks that are going to be suited for me.
Okay, excellent. That's good to know. And what is the good side of them in the note world?
The good side of buying that paper?
Of this happening?
Well, and of course, I don't have a crystal ball. I say this all the time. So if Fannie Mae's not going to buy that product from the bank, well, who do they have to sell it to? Well, someone's going to buy it, like I said before, but it's just not going to be at the price point that Fannie Mae would pay for it, right? Because Fannie Mae and Freddie Mac and those other GSEs, they're going to pay pretty much top dollar for these loans. Like, we'll just say 97 cents on the dollar, or some number up there, really high up there, right? But they're going to do it over a grand scale of, thousands and billions of dollars worth of loans. Thousands of loans, but billions of dollars worth of unpaid balance, right? So that's what their quandary is. So I don't see them having an issue selling it. It's just, who would they sell it to, and at what price point were they willing to buy it for? So the silver lining, I guess, as investors, is that inventory could come, and we're talking about non-owner occupied properties. So the second home is really a non-owner occupied property, because it's more of it's a second home. So they don't live there full time, right? It may be seasonal, or they may rent it out like as an Airbnb, or they may rent it out as a true rental, or a vacation rental, or a seasonal rental. So those would be non-occupied. So those don't fall under certain rules and regulations. So true owner occupied homes, like the home that I live in, or that Elizabeth lives in, or that you live in, That's an owner-occupied loan, and they have rules that have to follow the Dodd-Frank and CFPB guidelines. So with them tightening the restrictions on those non-owner occupied type of loans, it means that they see an issue with potentially with borrowers, and they want to make sure they have the cream of the crop type borrowers that are getting these loans from the banks.
Okay. Very, excuse me, very interesting.
Yeah, it is. People may have glossed over that if they read that, but I'm reading a little deeper into it to have a better conversation of what do I think that means and what it could look like. This could not be a problem at all. They could change their mind and realize, okay, well, we'll still make a deal with you, but we'll change our price point. But right now, when this article came out a few days ago, I'd say 7 days ago, they were alluding to the fact that you're just going to get tighter on that stuff. So I'm just assuming they're going to follow suit, just like when COVID-19 hit back in February and March. Chase came out with an article that said, well, if you have a 720 credit score and 20% down payment, you can get a loan, right? Maybe a month or two before that, it was a 780 credit score and maybe not as big of a down payment will get you a loan, a conventional loan. So this is just what happens in these economic times. And
I just want to, just a special note to everybody, we are educational only. We're not, this is not things that you need to do. We're not giving advice. These are our own, thoughts, what we see, from the industries that we work in. And I say that because there are some different schools of thought about what can be done, because we are the Two Wealth Show. So we're all about educating people on ways that you can invest your money.
Yep.
So one of the things, if you say, hey, you know what, I see this as an opportunity for your investment strategies, is to borrow money, right? So that you can take advantage of maybe being a private lender, doing hard money. There are different courses, and depending on what state you live in, you'll need to have different license or different permits or whatever is required for that. But then also, there could be, like Justin was saying, an opportunity on the note side of this. So at any rate, there's always an opportunity, there's always a plus and there's always a minus, but, just make sure you really know, hey, is this something that you would want to invest in, excuse me.
Elizabeth, money today is cheaper than money tomorrow.
That's right. That's exactly right.
Speaking of money and inflation, what else is going on? Let's talk about not specifically notes, but on the let's talk about the building side.
So this is really interesting. Most of y'all know that I do teach once a month for CIREIA, the Central Indiana Real Estate Investors Group, and last night, or association, not group, I had a special guest who's my insurance agent. Excuse me. And one of the things that came up was that on your policies, whether it's your personal property or your investment properties, there is something called that you're either insured for replacement value or market value. Okay. And those are two very, very different scenarios. And his advice to everybody is to do replacement cost. So, and you might be thinking, oh, but real estate's appreciating, it's going up right now, but we don't know when that's going to end. And the other thing that's really important with replacement value is the fact that we've seen huge material costs increase on wood, on electrical components as well. And as you know, most of the time when prices go up, they're not going to come back down. So it's really important that you are insured for, again, my guy recommends the replacement value of your property. And then there's also something on policies called, I'm just going to look at my notes, extended coverage, which also just goes into effect whenever you have some different amenities in your property and to make sure that additional things are covered. So you might think, before, whenever I would meet with my insurance guy, I'd just be like, oh, I just need this, this, and this. No. It's very, very important that you are covered both in your personal property and in investment properties.
Absolutely. I couldn't believe how much the prices of materials have changed, because when we were remodeling our house over last summer, we were told that by the contractors, is like, Well, you may look at, they have sticker shock on this price, but I'm telling you, the materials that we're getting, we have no control over the price. And it kind of is what it is. Like our labor is this cost, but our material went up by this factor because of, this, that, and the other. And lumber was a big one. Mm-hmm. And treated lumber was even more difficult to find as well. So we had to wait quite a bit for some of our materials to come in to finish the house we were remodeling over the summer. So I can't imagine what it is now, because I'm sure it spiked a lot higher than what it was over the summer, or I'm sure the material it's probably not as short. Is there a shortage of material as well, and the prices are going up, or prices are just going up?
So it depends on what you're going for.
Okay.
Yes. And I'm sure the area depends also as well. So I know just three lots down from where I live personally, they're building a brand new house, and there was a lot of lumber delivered. I don't know if there was a delay in that, but there was a significant amount. But at one time we did have as well, we had some electrical, because my electrician was here to do some work, and he was actually starting to save some items just to make sure that he had them for customers.
Wow. I mean, that's a good thought, right? It's good heads up on that person's part.
And absolutely. And, just one of the things we've talked before about prepping for if there's a natural disaster or something. One of the things they also say, just because we're talking about building here, is to also have screws, nails, plenty of those on hand as well.
That makes a lot of sense.
Mm-hmm.
So do you think that the fix and flip real estate investors are struggling right now because of this material shortage, because of the inventory shortage? Like, is it becoming even more challenging for them?
I don't think so, because they're making the money up on whenever they sell it. So actually I should say that while their costs are going up, the customer right now is willing to pay that increased money for the property, because we have this property shortage.
Okay. Well, that's good.
Mm-hmm. It's great. We did a construction clean a few weeks ago, and my client bought the property for $130,000. I don't know what he put into it, not a lot of money, but he was selling it for $260,000 in 5 months. And that's how you make money. And part of that is knowing the right areas to buy, what are the ARVs, so the after repair value of the properties, doing your research, or having people that you trust that can give you accurate value, so you can invest for whatever needs, for whatever your reasons are.
Are you involved with a lot of appraisals from traditional appraisers with properties nowadays? No, I
am not. No.
I was wondering if maybe it's a real estate agent that we should ask this question to, is, are they just going with the purchase price and giving it its value, or are they truly, because it seems like if values keep going up in certain areas, how are they using their subject property against the comparables? Are they just going with the purchase price that's on the contract or higher?
Mm-hmm. So I do have to say, I am a real estate agent, and even though that's not what I do, right? But I'm just making that clarification, Justin, because in the state of Indiana, if you manage for other people, you are supposed to, by law, have your real estate license.
Okay.
And I'm making kind of a point of this also because we had the Attorney General for the state of Indiana, Todd Rokita, at our CIREIA meeting, and that was actually a big item that came up. And he's finally going to go after people that are managing properties that are not licensed real estate agents. And one of the reasons that this is a problem is there are certain protocols that we have to follow as a real estate agent, especially whenever we're leasing properties. I can't ask them hardly anything. How many kids do you have? I would never ask that question. All I can say is how many adults? And I can say, okay, this property is limited to 2 people per bedroom. So there's a lot of things that you have to be really cognizant of when you're an agent. So, and this, just kind of ties back also to, we talk a lot about now, especially being involved with your legislators, your local legislators as well. And because we had that meeting and we brought it to his attention that, hey, this is a huge problem in real estate, that he's going after it.
Wow. So let me ask you a question, because maybe I don't understand exactly what that means. And so my question to you is, if you are a landlord and have one property, are you technically managing it? And then if you're managing it, are you having to get your real estate license? Is that what you're saying?
So if you manage for other people, you don't have to have a realtor's license for your own personal properties.
Okay. So like if your company is a management company to manage properties that other people own and have tenants in, okay, now I understand you.
Yes. So for me, if I managed only my own properties, anybody that was on my team working for me, we don't have to have them because they're my properties.
Yeah. Okay.
So
that makes sense. Well, good.
And what's interesting too, Justin, and for all of our listeners, is that when somebody raised the question, and Attorney General Rokita had his right-hand man, his first name is Derek there, and he said, "Hey, is this actually a problem?" And Derek said, "We've had over 100 calls this week about it."
Are you allowed? Do you remember what the question was?
Yes, as far as having people that are basically people that are managing properties that do not have their realtor's license.
Okay. Wow. So just that week they had just 100 phone calls on it.
Correct. Saying, either reporting people that are acting as realtor or, as real estate, people managing other people's properties. Wow.
Well, good for us getting a change going then.
Yes. Cause I paid the money. It's about somewhere around $1,500 to $2,000 a year for me just to have my license. So that's a pretty significant, business cost.
Absolutely. It is. Yeah.
So, I took the time to take the classes and pay for the classes. And so it's important. Know the laws and regulations of your state.
Yeah, it is important. And it's great to have a local group like where we're at, CIREIA, and then our in-state RIA as well, to have folks like you and bringing in the Attorney General to talk about this stuff. That's great. Otherwise, I honestly wouldn't know about the state regulations unless I heard of somebody that got in trouble for something, or unless it was an article that came out that was in some sort of my news feed, right? So that's great to have. So if you do have a local real estate group or real estate club in, close to you, I encourage you to go visit it.
Absolutely. And if you don't, then go ahead and start your own, because there are plenty of real estate investors that, need help and want to not only need help, but they want to congregate and network with other real estate investors so we can just continue to get better.
And otherwise, we wouldn't have been able to have our Indiana State RIA if we didn't have smaller RIAs around our state to get together to realize, hey, we have a common problem. Let's pool our resources and our knowledge together to see if we can come up with solutions. And lo and behold, we've been able to make some changes and some headway for Indiana specifically, right? Huge
headway. 2 bills passed in 3 years, which is almost unheard of. So
2 bills passed in 3 years. Very nice. And so speaking of Indiana State RIA, I believe coming up very soon, when this episode airs, it's probably going to be a couple days, but it's April 15th and 17th.
15th through the 17th. Yes.
15th through the 17th. It's going to be partly on Zoom and partly in person. And where can we go to get tickets for that?
Indiana State RIA. So real estate.
REIA.
Thank you. .org. We'd love to have you. Like Justin said, it'll be both Zoom and in person. So whatever you feel comfortable with. We do have a VIP dinner that Friday night as well, with a meet and greet with Trey Hollingsworth, who is a representative. He's U.S. congressional representative, and we have some other lawmakers coming as well. So whether you live in Indiana, but if you invest in Indiana, we would absolutely love to have you. And it's important that your voice is there and your voice is heard.
Absolutely. Elizabeth, I think that's a great way to end today's episode. So this was episode 7. If you're listening to this on a podcast, remember that we also video cast this on the Bright Path Notes YouTube channel and Elizabeth Mayora's YouTube channel as well. So I'm Justin Bogard with Bright Path Notes.
And I'm Elizabeth with Elizabeth Mayora.
All right. See you next time, guys.
Thank you.
The Two Wealth Show is produced by Justin Bogard and Super E, sponsored by Bright Path Notes and Elizabeth Mayora. Thanks for listening and watching for our show.